morning, Dion. You are live now. You can start. Thanks.
Thank you, Sianda. Good morning, everyone. Thank you for attending this facet class for the FAC 1502 students, but then also for the FAC 1501 students, because our topic today is also applicable for you. The topic that I will be presenting today is trade and other receivables. But first, let me just introduce myself. If you have not attended last Sunday's presentation, it was also presented by me, Mr. Dion van Vel. And then also I have here my two colleagues, Mr. Sianda Mkadi and Mr. Ntlatlana Mokona. They will be answering your questions, because while I am presenting this trade and other receivables, you will be able to ask questions in the Q&A. So any questions that you have while I'm presenting, I will not be able to see them, but you can ask them in the Q&A and my colleagues will answer them. And then at the end, I will also ask if there are any other questions after I've presented, if you then still want to ask a question. But let's start. Like I said, today it's going to be trade and other receivables. Trade and other receivables will be part of your current assets. Now, remember in the first presentation by Mr. Mkadi, he introduced you to the different elements: your assets, your liabilities, your equity, your income and expenses, and trade and other receivables will fall under your assets. But then under assets, you have your non-current, which will be those that you're going to make use of to provide income to your business. But it's not going to be something that you're going to buy on a daily basis. They will be the ones that you will be using for a longer time period, like your computers, your equipment, your machinery. And then you get to your current assets, which the lifespan is more or less 12 months or less. It's these balances that will be changing on almost a daily basis, some of them, and others will change on a weekly or a monthly basis. But those will be changing during the 12-month period of your financial year. Now, in today's lecture presentation, we will be looking at the following. The first one is you need to understand how to calculate the amount of settlement discount granted on the early payment of debts, calculate its effect on VAT, and record the relevant transactions. Secondly, you need to understand how to calculate the amount of allowance for credit losses and record it in the books of the entity. Thirdly, you need to understand how to record the entries involving credit losses, which you also might know as bad debts that have been written off. And then fourthly, understand how trade receivables are disclosed in the statement of financial position. Fifthly, understand how to prepare a trade receivables control account. And then we're going to look at one of the exercises. Now, your trade and other receivables, remember that's basically your debtors. You know that if you sell to someone on credit, that business or person will be your debtor because that person owes you money. When you buy from someone on credit, then that person will be your creditor. But what we're going to look at today is the debtor side, the asset side. So anyone that buys from you on credit will be your debtor. Now, when a debtor settles his account and he does it within a certain period, less than what the credit terms in the credit contract with that debtor specifies, then normally a business will provide or will give such a debtor a settlement discount, and that we call settlement discount granted in the books of the selling entity. Now, when a debtor wants to buy on credit, he must first apply. So if I can just explain to you the process in a business, not everybody can just come and say, I want to buy on credit, because it all depends on your credibility. So you need to apply. So if a business do provide customers to buy on credit, those customers will have to first apply for it. And they will have to provide their financial details so that the business can decide. And when they look at all these financial details of the client, if this client is creditworthy, because I mean, you can't take the risk as a business to sell to someone on credit and he will never be able to pay you. Then, I mean, it's almost like giving that person the stuff for free if he's never going to pay you. So the process, it's an application that you must first do to get credit, to apply for credit. And then secondly, there must be a contract, like anything, to determine how much, firstly, will you be able to buy on credit, your payback terms, you know, how long do you have to pay back, and then also like the settlement discount granted, how if you pay in less than the credit terms, then you might get a settlement discount. So all those things will be in a credit contract with the client, and that can differ per customer depending on that customer's credibility. You can't just give anybody, let's say, 100,000 credit that they can use. It all depends on that business, its own financial position. Will that client be able to pay back that amount? Now, a discount is often offered to debtors in order to encourage their quick settlement of their debts within the stated credit term. Now, if we look at this example, a client purchased goods worth 3,450 Rand on credit on 1 March 2020. The client has 1 month. Now, that's the credit term in which to settle the debt. If the client pays before 31st of March 2020, a discount of 2% will be granted. If the client settles the account before 31st of March 2020, it means that the amount payable is 3,381 Rand, calculated as follows. Now, so normally the client will have a month to pay. So if the client purchased on the 1st of March and he then settles on the 31st of March, he will just pay his normal 3,450. But if the client or debtor settles his debt before that 1 month, so let's say he pays on the 15th of March, then he's going to get this 2%. And I mean, who don't want to pay less for something? So this is definitely almost like a carrot that you put in front of someone, because that will determine the debtor to pay earlier, because he can get discount. So he will buy for 3,450, but if he gets this 2% discount, he will only pay 3,381 Rand. Now, to calculate it, we said the amount is 3,450. You take 2% from 3,450. That will give you 69 Rand. So the discount on 3,450 will be 69 Rand. And if you subtract that from your 3,450, that's how you then get your 3,381. So you will receive 69 Rand, the debtor will receive 69 Rand credit, and the business is giving That's why it's settlement discount granted of 69 Rand. Now, we know that is always applicable. During your sale, your VAT was applicable, and also with your settlement discount granted, there will be a VAT implication. Now, if the value added tax is 15% and it's included in the 3,450, the VAT collected on behalf of the South African Revenue Service recorded in this sale will amount to the 450. And to calculate the VAT output on sales, one will do the calculation by saying 3,450 multiply with 15 over 115, and that will give you your 450. Now remember, the reason why we use here the 15 over 115 is because the 3,450 includes my VAT. So it's the VAT inclusive amount. And to get my VAT amount, when I already have my VAT inclusive amount, I must multiply it with my 15, which relate to my VAT, and the 115 relates to my VAT inclusive amount. So that's why I use 15 over 115, which will then give me 450. Now, if we had the VAT exclusive amount, the 3,000 Rand, because you see there, I said therefore sales is 3,450 minus the 450 we've calculated. So our sales amount, which is the VAT exclusive amount, is 3,000 Rand. Now, if you take that 3,000 and you want to calculate what the VAT also was, so working this time with the VAT exclusive amount, you would have said 3,000 multiply with 15 divided with 100. So the 15 again that you would have used would have been related to the VAT, and the 100 which you would have used in this instance is related to the VAT exclusive, because your VAT exclusive will be equal to the 100, or your VAT inclusive is equal to the 115. So when you have the VAT exclusive amount of 3,000 and you want to calculate the VAT amount, you must multiply it with the 15 over 100. Where if you have the VAT inclusive amount, you use the VAT inclusive amount multiplied with 15 over 115. But you will get the same answers. It's just you start with different amounts, either the VAT inclusive amount or the VAT exclusive amount. And that will determine which formula you must make use of. Now, our VAT input on the settlement discount granted, to calculate that, we also then going to use the VAT inclusive calculation, because the 69 Rand is inclusive of VAT. And remember, our settlement discount granted is an expense, where our sales, that's an income. So when we calculate the VAT on the sales, that was VAT output, because my VAT output relates to my income and my VAT input relates to my expenses. So when we calculate the VAT on the settlement discount granted, that VAT will be a VAT input, whereas my previous calculation on the sales, there the VAT is a VAT output, because that is, like I said, with my income. When I calculate VAT on an expense, that VAT that I'll calculate will be a VAT input. So our settlement discount granted, which includes the VAT, is the 69. So I must multiply it with 15 over 115. Because the reason again for the 115 is my 69 includes the VAT. So it's my VAT inclusive amount. So I must multiply it with the 15, divide with the 115, which will then give me the 9 Rand. So therefore, my settlement discount granted is 69 Rand minus the input VAT of 9, which is 60 Rand. So when I'm recording my settlement discount granted expense, it will be the 60 Rand, Because remember, when we record our expenses or our income, with the sales, my sales would have been the 3,000 Rand, and my VAT output would have been the 450 Rand. Whereas my settlement discount granted, my settlement discount granted expense would be 60 Rand, and my VAT input will be 9 Rand. Now, you also get an allowance for settlement discount granted. An entity with a settlement discount granted policy applicable to debtors who pay their accounts fully in the settlement period must at the end of the financial year create an allowance for settlement discount granted for those sales that took place in the current financial year, but in respect of which the settlement period falls in the next financial year. So during your current financial year, you have sold to your debtors, let's say in the last month of the financial year. But those debtors will only pay you in the following financial year. Although they might have that 1 month period to pay you, they might then pay you also again within 15 days. But that 15 days is already going to be then in your following financial year. Now, to provide for those, that's where we have then to come and create an allowance for settlement discount granted. Because those debtors have already bought in the old financial year, and you must already, when you prepare your financial statements, indicate that your sales and debtors, it's actually going to be less, because those debtors will actually pay you less because they're going to get a discount. You're going to provide them with a settlement discount granted. But because they're only going to pay you in the new financial year, that transaction will only take place in the new financial year. But in the old financial year, you must already indicate that my debtors is actually a lower amount. What's currently showing in my books is not actually what I'm going to receive. And to do that, you must bring in your allowance for settlement discount granted. Now, let's look at the example. On 30 June 2020, the end of the financial year of prior traders, the outstanding trade receivables control account amounted to 30,000 Rand. And the sales amount to 70,000 Rand. The entity's credit policy allows a settlement discount granted of 5% if an account is settled within 30 days after the sale took place. Over the years, the entity established that 90% of its customers take up the settlement discount granted. So from historic information, it's possible to determine that more or less 90% of the debtors normally make use of this settlement discount. So at the end of the financial year, we're then going to make use of that information when we need to calculate and bring in this allowance for settlement discount granted. Now let's look at the calculation. We said our debtors, if I just go back, we said there, my trade receivables control account amounted to 30,000. So that's where we get our 30,000. All right. And we said 90% of them make use of the discount. So first we have to calculate our number of debtors, or the amount that we're going to calculate the discount for. So 90% of my 30,000 gives me the 27,000. Then we said that the entity gives 5% discount. So my allowance that I need to calculate, we're going to then make use of the 27,000 and calculate 5% of that, which gives us 1,350. So that's basically what we think that we're gonna grant these debtors. So in the following financial year, probably 1,350 Rand will be the discount that we're going to grant to those debtors when they settle their debt before the 30 days. So to make to do a general journal entry, it will look like this in the books for Brio traders in their general journal. First, we will say debit our sales with 1,350, and then we will credit our allowance for settlement discount granted. Now, allowance for settlement discount granted was created at year end. So we must firstly make our sales or make the adjustment for our sales of 1,350. So therefore, we know sales, it's an income. And to decrease an income, you must debit an income. So therefore, we will have to decrease our sales with 1,350. And we then create this allowance for settlement discount granted. So we credit our allowance for settlement discount granted of 1,350. Now, just to show you how it will look in the different financial statements, firstly, our statement of profit or loss and other comprehensive income for the year. That, remember, your statement of profit or loss and other comprehensive income is a statement that only work with your income and expenses. That's where you want to calculate at the end of the financial year your profit or loss for the financial year. So in that statement, you will only find your income accounts and expense accounts. Now, our sales will be classified under revenue, but that's we will do at a later stage when we look at the financial statements. You will then see the structure, and sales will be shown under revenue. So you will have there your total sales for the year, and then you will have your deduction, where we're going to say less settlement discount granted, which is those debtors that already paid during the year and made use of that discount. So that amount is during the year, those transactions already took place. So those debtors already paid you. So you already received that money. So therefore you already recorded it as settlement discount granted. But then you have all these debtors that at year end that might make use, that 90% that we set for this business, and that you bring in here under where we say less allowance for settlement discount granted. So that 1,350, that's where we're going to bring in that amount. So to show our sales for the financial year, it will be our sales that actually took place, less than the settlement discount granted, less our allowance for settlement discount granted. And on the financial statement on the statement of financial position, that's also previously we called it the balance sheet, and the statement of profit or loss and other comprehensive income that we call the income statement. Now the balance sheet, that is only referring to your assets, your equity and your liabilities. So if you think of your accounting equation, that's basically your accounting equation just in a different format, because we say still assets equal equity plus liabilities. Now, in our statement of financial position, we will have our trade and other receivables, under which you will then find your trade receivables, your debtors, your trade debtors, the people that you sold to on credit, less than your allowance for credit losses, and also less your allowance for settlement discount granted. Now, we will be looking at our allowance for credit losses later in this presentation. But currently, the important one here is then the allowance for settlement discount granted, the 1,350, because we debited our sales with 1,350 and we credited our allowance for settlement discount granted. Now, so your allowance for settlement discount granted will have a credit balance. Although it is an asset, it still remains an asset, but we call it a contra asset or negative asset, meaning although it is an asset, it does not have a debit balance, but now it has a credit balance. Another example of a contra asset account will be your accumulated depreciation. That's also something that one is going to deal with later in the module. But that one is also a credit balance. Your allowance for your accumulated depreciation account is also a credit balance account, which is also a contra or negative asset account. When debtors don't pay you or don't pay on time, definitely you're going to charge them, because I mean, you're not a bank. I mean, you can't provide them with finance, because that's basically what they're doing. If they can't pay you, they almost get a free loan from you. Now, you need to pay your creditors, so it's very important to make sure that your debtors pays you on time, so that when you need to do your payment to the creditors, you need to have your cash available. So if your debtors don't pay you, you won't be able to pay your creditors, and then they will definitely also charge you with interest. So many entities charge interest on outstanding debt if an account is not paid within the credit term. Now, let's look at the calculation. If a client does not pay an account of 550 Rand before 31 March 2020, but only pays it at the end of April. So, I mean, so the credit term said he must pay within 30 days, which was 31st of March 2020, but then he only paid on 30 April. The client will be charged, let's say, the current prime rate is 18%. That's not what it's now, but let's say for this example, the prime rate was 18% per annum. Then interest will be calculated for that month on the 550 Rand. And that will add the interest you will add to the amount, which will then give a total of 558 Rand and 25 cents. So the way to calculate it is you take your outstanding balance, multiply it with the 18%, and it's only for 1 month. So you must then only calculate it for 1 month, which will give you then 8 Rand and 25 Rand, the interest for that month, which you then add to your outstanding balance of 550 Rand. That will give you then an outstanding amount of 585 Rand and 25 cents, because you can't finance this debtor because you already gave him, you know, the opportunity to buy on credit, and then he must pay within his allowed credit period. And when he does not, then definitely he must be charged for that. And that's what happened here. He did not pay within 1 month, and therefore he needs to pay the extra 8 Rand and 25 cents. Now, the accounting entries of that specific transaction, if we record it in the, well, it will be recorded in the general journal, because you can't record it in your sales journal. It's not a transaction directly with the debtor, It's not where you sold to the debtor, so it will not be recorded through your sales journal. And therefore, you will have to then record it in your general journal. Now, what you will do is you will debit the account of the debtor and also the trade receivables control account, because remember, with your debtors, you have your debtors ledger, where there's a individual account for each and every debtor, or your trade receivables ledger, where there's a account for each and every debtor in your trade receivables ledger. And then you have your control account in your general ledger, which is the trade receivables control account. And your individual transactions will be recorded in the individual debtors account in the trade receivables ledger. But then at the end of the month, when you record only the total of the journals in your trade receivables control account, then you will only record the one total. But in the trade receivables ledger, there in every debtor, each and every transaction relating to that debtor will be recorded in detail. So when we make these recording of these transactions, we must always remember that the debtors account in the trade receivables ledger need to be adjusted as well. So therefore, we're going to debit the specific debtors account. We're going to debit the trade receivables control account in the general ledger with R8.25. And then we're going to credit our interest income account with R8.25. Because remember, our interest income is an income. And we said income accounts increase on the credit side. So therefore, our interest income account will be credited with R8.25. Now, when we sell on credit, there's always a possibility that our customers or clients, debtors, won't be able to pay us back, because I mean, suddenly there is COVID. If you think back, COVID that we had recently, businesses suddenly came to a stop because you could not buy and sell for a time period with the total lockdown. And then suddenly you were still selling or during March or February in 2020, you might have still been selling to customers. They were buying on credit from you. And then after that, March, April lockdown, nobody can pay, nobody can do anything. And you're sitting with bad debts. These debtors can't pay you back. That's a reality. I mean, that can happen. Anything can happen. Businesses can get trouble and don't have cash to pay. They might get cash flow problems. Their own debtors, they don't pay them. Then the business does not have money to pay their creditors. And yeah, that become then your problem, because they are your debtors. You are their creditor and they are your debtors, and they can't pay you. Now, when a credit transaction occurs, there's always a possibility that the debt might not be paid. Now, those debts that are never paid are known as credit losses or irrecoverable debts. Because there's always the possibility that some debts will not be paid, most entities have a policy of creating an allowance for credit losses. So where we previously had the allowance for settlement discount granted, because some clients can make use of it after year end, now we have the allowance for credit losses, where there's a possibility that some of our debtors won't be able to pay us back. So again, we will have to create an allowance for that purpose. Now, when one is writing off credit losses, entity's management may decide that a specific debt will not be recovered. The amount must be written off as a credit loss. And when the credit loss is written off, the debtor's personal account and the trade receivables control account are affected. So one must always just remember, in the debtors or trade receivables ledger, you're going to have the individual debtors account there, so that must be written off. And then you must also adjust your trade receivables control account in the general ledger. Because remember, when we, at the end of the month or at the end of the year, when you check all the balances of all the individual debtors in the trade receivables ledger, if you add up all those totals, that must be equal to the total of your trade receivables control account. So if you're going to forget to make a entry in the specific debtors account and you want them to compare at the end the total of all your debtors in your trade receivables ledger, and you want to compare it with your total of your trade receivables control account in your general ledger, then that will not agree, because you did not make that entry in your debtors account in the trade receivables ledger. So one must just always remember, if you do it in the one, it must also be done in the other one, meaning that if you've done it in the debtors account, you must remember it must also be done in the trade receivables control account. If you've done it in a trade receivables control account, you must remember that you do it in the specific debtors account. Now, let's just look at an example. On 15 May 2020, AM Traders was informed that A. Langa, a debtor who owed the entity 660 Rand, had been declared insolvent. So that's meaning he doesn't have money to pay them. The amount must be written off as irrecoverable, meaning that they're never going to receive it. So there's no reason for keeping it on the books, because you will have that amount lying there for years and never you will receive that 660 Rand. So we were informed it's irrecoverable, we will have to write it off. Now the balance on the trade receivables control account at 30 April was 18,000 Rand. Now if we look at the accounting entries for this specific transaction to write off the 660 Rand in the general journal, it's going to affect firstly our credit losses account, which is an expense account. So we said expenses increase on the debit side. So therefore our credit losses account will be debited with 660 Rand, and our debtor, A. Langa, and the trade receivables control account will be credited with the 660 Rand. So remember, our debtor and our trade receivables control account, these balances are debit balances, because we said debtors are current assets, assets have debit balances. So to write it off, we must then credit them. So therefore, the debtors account and the trade receivables control account will be credited with 660 Rand. Now, we said we're going to create an allowance for credit losses, and it is customary for entities that sell goods on credit to create an allowance for credit losses. This allowance is based on the estimated credit losses, our bad debts. The prospect of not realizing all debts is typical of this type of uncertainty. A thorough investigation needs to be done of the debtors of an entity every financial year to determine which debtors are at risk of not paying their accounts An amount for the possible allowance for credit losses will then be determined. So what we're saying here is that during the year, you're going to sell to your clients, customers, and on debt, those that do have a credit contract with you. And during the year, things can happen that can almost raise red flags that, I mean, a certain debtor is paying late, a certain debtor don't pay the full amount. So you already can see that there are signs that there's problems with that debtor. So already you will be able to say, but there's a possibility that this debtor might not be able to pay me. And for those ones, you then need to go and create this allowance for credit losses, because remember we said our amounts in our financial statements, it must be the amounts that we present must be amounts that we know will be recoverable. We must know that if we say 100,000 Rand is the balance of our debtors, we must know that 100,000 Rand we will receive at the end. But if we know that this specific debtor that owes us 10,000 will not be able to pay us, or there's a very good possibility, then we can't say our debtors is still, let's say, 100,000 Rand. It's now 100,000 minus 10. So we must actually say our debtors that we think, or the amount that we think that we will get from our debtors will be 90,000 Rand. And therefore, we're going to bring in this allowance for credit losses, because remember, our debtors, our trade receivables balance will have a debit balance of, my example, let's say 100,000, and our allowance for credit losses will have a credit balance of 10,000. And we're going to deduct that 10,000 then from the 100,000. So we keep our trade receivables control account at 100,000. We don't, go and make changes to that. We bring in this allowance for credit losses so that we, at the end, when we set off the allowance, or when we deduct the allowance for credit losses from the trade receivables balance, we will only have an amount of 90,000. So we have the actual 100,000 trade receivables less the allowance for credit losses of 10,000, which will tell us that we expect to receive 90,000. Now, if we look at an example, now remember all these examples come from your study unit 9 from the FSC 1502 study guide. So all these examples that I'm referring to come from that. So if you don't understand and you want to go back, you can go back to those examples in your study guide. But it's also provided here. So on 30 June 2020, the end of the financial year of trio traders, outstanding trade debtors amounted to 20,000 Rand. The financial manager determined that the allowance for credit losses account should amount to 1,350 at 30 June 2020. So like I explained, they went through their debtors book. They went through the debtors trade receivables ledger. They analyzed everything, and then they made these, they probably saw that there are possibility that a debtor or debtors amounting to 1,350 won't be able to pay them, or there's a very good possibility that they will not receive this 1,350, and now they're going to create the allowance for credit losses. Now, how we're going to record it is in our general journal. We will then debit our credit losses account, which is an expense account of 1,350, and we're going to credit our allowance for credit losses of 1,350 rand. So we said expenses increase on the debit side. So our expenses, our credit losses increase, and therefore we have to debit our credit losses with 1,350 rand. And our allowance for credit losses must be credited because it's an allowance, it's a negative asset account or a contra asset account. So therefore it will have a credit balance, and therefore we credit our allowance for credit losses with the 1,350. And this is the allowance that at year end was created, because previously there was no allowance, and now we have this allowance of 1,350. Now, when one comes to, let's say, the following financial year, and we need to do an increase in the allowance, because, I mean, every year you will have to go and do this calculation or analysis where you will have to go through your debtors and determine which ones might not be able to pay you back. Because at year end, the amount that we show for our trade receivables should be then the amount that we expect to receive. And if we have doubts that there might be debtors not able to pay us, we must then bring that into account. So if we already have a allowance, we will then have to adjust it, because it can either go up or it can come down. I mean, if suddenly we have more debtors that are going to owe us, or if there are more debtors that might not be able to pay us, then we will have to increase that allowance. But if we have a year where our allowance must be come down, then we will have to again adjust it so that our allowance is the correct amount. Now, for this example, we will going to increase the allowance for our credit losses, and that's already based on the allowance that we have already created. So on 30 June 20.1, the outstanding trade debtors of Trio Traders amounted to 30,000 rand. The balance of the allowance for credit losses account on 1 July 20.1 was 1,350, because we created this on the 30th of June 20.1. And the allowance that we've created was 1,350. Now, credit losses already written off during the year amounted to 730 rand. So those were then new credit losses that we wrote off, debtors that became irrecoverable during the year, and that was 730 rand. Now, the financial manager determined that the allowance for credit losses account should amount to 1,750 at 30 June 20.1. Sorry, my mistake previously. Yeah, we created at the 30th June 20.0, we created the 1,350. Now we are at 30 June 20.1, where now our allowance must be 1,750 rand. So to bring that adjustment in our books, we need to do the following general journal, not general ledger, but general journal entry. So first we're going to say we debit our credit losses with 400 rand, because the difference between the 1,750 and the 1,350 is 400. So our allowance at 30 June 2020 was 1,350. Now it must increase with 1,750. Now, our allowance for credit losses had a credit balance of 1,350 at the end of the previous financial year. And now for the current financial year, it must have a balance of 1,750. Now, we know that it has the allowance for credit losses. It has a credit balance. And to increase that credit balance, we know that to increase that credit balance, we must credit it with 400 Rand. So therefore, we credit our allowance for credit losses with 400 and we debit the credit losses with 400. So in our general journal entry, we also showed you the calculation. So our new allowance is 1,750. Our existing allowance is 1,350. And that gives us the difference of the 400. And that's the amount needed for the adjustment. Now, like I said, your allowance can also decrease. And for this specific example, which is now the following financial year, we need now to make a decreasing entry. Now, on 30 June 20.2, the outstanding trade debtors of 2 traders amounted to 26,000 Rand. The balance of the allowance for credit losses account on 1 July 20.1 was 1,750, like we just did that entry to increase it from 1,350 to 1,750. The credit losses already written off during the year amounted to 960 Rand. And then after analyzing the debtors book, looking at all those possible debtors that might not pay us, it was determined by the financial manager that the allowance for credit losses account should amount to 1,550 at 30 June 20.2. Now, it was at the beginning of the financial year 1,750, a credit balance of 1,750, and now we are told that this must now decrease to a credit balance of 1,550. So to do that adjustment, to decrease the balance from 1,750 to 1,550, we will have to make an adjustment of 200 Rand. And we know it has a credit balance. The credit balance at the beginning was 1,750. So to decrease a credit balance, we must debit that account. So therefore, our allowance for credit losses will be debited with 200 Rand, and our credit losses account will be credited with 200 Rand. So when we look at the calculation in our general journal entry, we said our existing allowance was 1,750. Our new allowance must be 1,550, and therefore the amount needed for the adjustment is the 200 Rand. Now, writing off credit losses when an allowance for credit losses exists. Now, one can have two methods that one can use when you deal with this, because writing off credit losses when an allowance already exists, you can either make use of the allowance or you're going to write it off. So let's just quickly explain the two methods. Method one, you write the credit losses off against the allowance for credit losses account. As credit losses occur, the credit losses can be written off against the allowance for credit losses account as follows. Debit the allowance for credit allowance account and credit the debtor's personal account and the trade receivables control account. So there you're going to basically then decrease your allowance for credit losses. So instead of then saying that you're going to debit your credit losses and credit your debtor or your trade receivable control, you are going to debit the allowance for credit losses instead of the credit losses itself account, and you're going to credit then your debtor and the trade receivables control account. So that's method 1. Method 2, write credit losses off against the credit losses account. So this is the old way. The allowance for credit losses account remains unchanged during the year, and credit losses that occurred during the year are written off against the credit losses account. So this is the method that we started with, where we said you debit your credit losses account and you credit your debtor as well as the trade receivables control account, where with method 1 is when we have a allowance for credit losses and the balance is big enough. Then you can, for method 1, you can then, instead of debiting your credit losses account, you can then debit your allowance for credit losses account with the amount, but only up to the balance of that account. So if my allowance for credit losses is less than the amount that I want to write off, you can only use up to the balance of the allowance for that, and the rest will then go to my credit losses account. Now, one can also have a recovery of credit losses that was previously written off. So when money that was previously written off as irrecoverable, a credit loss, is recovered, it must be recorded and disclosed separately. So this means that previously you were told that the debtor is insolvent, you're not going to receive anything. So you then had to go and write that debtor off. So you would have said debit credit losses and credit my debtor in the trade receivables ledger, and you would have credited the trade receivables control account. But now it might happen that that debtor suddenly starts doing business again, and he would like to come and buy on credit from you again. Now he knows that you're not going to provide him with credit facility because previously you had to write him off because of his previous problems that he had. So you might say, no, I'm not going to give you a credit contract again. So he might, just to be able to get a credit contract again from you, decide that he will refund you basically, or he will pay you the amount that you had previously to write off. So all to get back into your good books, and also to apply again for a credit facility from you. So in those cases, you then going to receive that amount that you previously written off, but that you need to record differently. Now, the amount has already been removed from the account of the debtor and the trade receivables control account, and can therefore not be taken to that account. An account credit losses recovered will be opened for this purpose. The money recovered will be debited against the bank account. Your asset will increase, so therefore you debit your bank account, and the credit losses recovered account will be credited. So that's going to be an income. And income increases on the credit side. So your credit losses recovered account will be credited, your bank, an asset increasing on the debit side, therefore you debit your bank account. And the credit losses recovered are seen as an income and are added to other operating income in the statement of profit or loss and other comprehensive income to cancel the expense written off previously. So where you have written it off, you would have debited your credit loss, or credit losses, and you would have credited your debtor and the trade receivables control account. But now when you receive that amount that you previously wrote off, you're going to debit your bank and asset increasing. So if the debtor physically pays you that amount, so you debit your bank account and you credit losses recovered, which is now an income account. Your credit losses account is an expense, and your credit losses recovered is an income account. Now, the accounting entries are as follows. If we look at this example, an amount of 500 Rand for a debtor, M. Naidu, previously written off on 31st of March 20.0, was recovered on 1 May 20.0. So on 1 May, M. Naidu then paid you the amount that you previously wrote off. And the amount that you previously wrote off was 500 Rand. So therefore, my bank, I must debit with 500, and my credit losses recovered, I must credit with 500. Like we explained previously, my bank and asset increasing with 500, and my income is the credit losses recovered account, which I credit with 500 Rand. Now, our transactions regarding our debtors. We said that we have our trade receivables ledger, where we record any or every individual transaction with a debtor in that specific debtor's account. And then we have the trade receivables control account, which is an account, a control account in my general ledger or my trade receivables, where when I post at the end of every month, and I post from my CRJ, because in my CRJ I will receive my payments from my debtors. So my CRJ will have an effect on my trade receivables control account. My CRJ will also have an effect on my trade receivables ledger for that specific debtor. Then I will have my sales journal, where my credit transactions relating to my debtors will be recorded, and each and every individual entry in my sales journal will be recorded in the trade receivables ledger for that specific debtor, each and every individual transaction. But at the end of the month, I will only post my total credit sales to my trade receivables control account, because my amount that my debtors owe me, my sales plus my VAT output that they owe me, I only going to record the total of that in my trade receivables control account. Because remember, we said we have the ledger, the debtors ledger, where we will record the detail, but we can't record that detail in our general ledger. So therefore, we only post the totals of our journals to our accounts in the general ledger. So my totals from my sales journal will only be posted to my trade receivables control account, whereas the individual entries in my journals will go to the different debtors accounts in the trade receivables ledger. Therefore, our sales returns journal, therefore, those individual transactions will also be recorded in the trade receivables ledger in the specific debtors accounts, and then the totals at the end of the month will only be posted to my trade receivables control account. Now, many entities sell their goods on credit. If only one or two credit transactions occurred, an account for the debtor can be opened in the general ledger, and the specific debtor will be debited and the sales account credited with the amount of the transaction. So it's when you only have a few transactions or a few debtors, posting from the journals to the trade receivables ledger takes place on a daily basis. Now, when you have only these few debtors, then you can do it like this. But when you have a lot of debtors and a lot of transactions, then you can't do that. Now, to obtain a complete record of all the transactions, a control account is kept in the general ledger. The trade receivables control account contains a summary of all the entries made in the individual debtors' accounts. Because, I mean, otherwise your account in the general ledger, it's going to be too bulky. And therefore, you don't want the detail. The detail you can find in the debtors account in the trade receivables ledger. That's where you're going to find the detail. And in the journal, in the sales journal or the sales returns journal, you are going to find the detail of the transaction. But in your control account, you only want the total. Posting to the trade receivables control account takes place once a month when the totals of all the subsidiary journals are finalized. So our daily posting will happen to our ledger, our trade receivables ledger. And then at the end of the month, you will have only then because the reason for the daily is to get the details in the trade receivables ledger, where you need to have every transaction that occurred during the month on a daily basis with a specific debtor you need there. But at the end of the month, your total transactions coming from your subsidiary ledgers will only then be posted to the trade receivables control account. Now, okay, this is not the end of our slides. What I'm now going to do is I'm going to go to our study unit in the general ledger itself, where we're going to look at the trade receivables control account. Now, I said that it's only going to be our totals that we post to the trade receivables control account at the end of the month. And this is an explanation of the procedure that you will follow. Now, like I explained, our individual entries in the sales journal are posted to the personal accounts of our debtors on the debit side in the trade receivables ledger on the days the transactions take place. So every time when there's an entry at the end of the day, when you're going to do the entries that comes from your specific journal, from your sales journal, you're going to post it then to the accounts of the debtors in the trade receivables ledger, so that you can have those individual entries there. And then the total of the trade receivables control column in the sales journal is posted to the trade receivables control account on the debit side on the last day of the month. Now, remember, our debtors are assets. Assets increase on the debit side. And these are our sales that we made, the credit sales that we made to the debtors. So the reason why we say here the debit side, our debtors increase. We are selling to them on credit, so our asset is increasing, and to increase our asset, we must debit it. So therefore, the credit sales transactions or the transactions regarding the sales are recorded on the debit side of either the account of the debtor or then the trade receivables control account. And the individual entries in the sales returns journal are posted to the personal accounts of the debtors on the credit side in the trade receivables ledger on the days the transaction take place. Now, remember the sales returns journal, we use that to record the transactions when our debtors send back their products that they bought from us. Either it's because the item was broken, it's the incorrect item, so there was something wrong with the specific item that they bought from you. Now, when they return it, their amount that they owe you will decrease because they have sent back some of the inventory that they bought from you. So definitely the balance, the amount that they owe you must decrease. And we said to decrease an asset, because a debtor is an asset, assets decrease on the credit side. So that's the reason why all these sales returns must be recorded on the credit side of the account of the debtor. And then the total of the trade receivables control column in the sales returns journal is posted to the trade receivables control account on the credit side on the last day of the month. So you see again, the individual entries, it's done on a daily basis, but then the total of the trade receivables controller column in the sales returns journal is posted to the trade receivables control account on the last day of the month, because it's only the total that you need to post, and the total you will only have at the end of the month after you've totaled your sales returns journal. So you can't do that on a daily basis. It's only at the end of the month where you have totaled your sales returns journal, and then you will do that single entry for the whole month. Whereas at where you during the month every day you had to record every day the specific entries for the specific debtor that took place on that day to their specific account in the trade receivables ledger. You also have your individual entries in the cash receipts journal when they've paid you. Those are posted to the personal accounts of the debtors, the credit side, in the trade receivables ledger on the days the transactions take place. Remember, when they pay you, the balance will also decrease, the same as what happened when they return stuff to you. Both the amount that they owe you must decrease. Either they return the stuff, so they don't have it with them anymore, so they don't owe you that amount. So to decrease their balance in your books, you need to credit them. The same when they pay you. They physically pay you, the balance, the amount that they owe you must decrease. And we said they are assets. Assets decrease on the credit side. So therefore, when they pay you, that transaction must be recorded on the credit side in their accounts in the trade receivables ledger. And then at the end of the month, the total of the trade receivables control column in the cash receipts journal is posted to the trade receivables control account on the last day of the month. So there again, when you have totaled your journal, your cash receipts journal for this example, you are going to then record that on the credit side of your trade receivables control account for the month. Now we're going to look at exercise 9.10. This will be the last item that we do, is working through exercise 9.10. But that will explain to you how you will record, or this is an example of what we've just done, looking at all the different types of entries that you will have in your trade receivables control account. Now, first we look at the information provided. The opening balances on the individual debtors are as follows. Debtor A is 450 Rand, debtor B 680 Rand, and debtor C it's 220 Rand. The VAT rate applicable is 15%. Now remember, all these amounts include or is VAT inclusive, because remember, when you record the transaction, your sales, when they buy on credit from you, when you record that transaction, you will debit your debtor with the VAT inclusive amount. You will then credit your sales with the VAT exclusive amount, and you will have your VAT output, which is also a credit entry. So my VAT output plus my sales amount will equal the amount of the debtor, which is the VAT inclusive amount. So this 450, the 680, and the 220 is all VAT inclusive. Now, during the May of 20.2, we have the sales journal. We have then transactions, and we sold on credit to customer A, B, and C, or debtor A, B, and C. We also have a sales returns journal for May, where we had debtor B and C returning some of the inventory or merchandise that they purchased from you previously. Then we have the cash receipts journal for May, where we have received payments from A, B, and C. And then we can see there, for example, customer A or debtor A paid before his credit term and therefore received a settlement discount. And therefore also debtor C paid before the before his normal credit term, and also received then settlement discount of 19 Rand. Then we had our general journal where we have sold furniture on credit to C. Now remember, our sales journal, it's only used for our credit sales of merchandise. Only what we trade in is recorded in our sales journal. So if we don't buy and sell furniture, then we're not going to record that in our sales journal. It's all the other non-current assets that we will sell, or assets that we sell that we don't trade in, and we sell them on credit. Those will be recorded in our general journal, because only what we trade in, which is sold on credit, will be recorded in our sales journal. So here we had the furniture that we sold on credit to debtor C, and then we received furniture back from C, again also through the general journal. So what is required from us in this exercise? Number one, prepare the trade receivables control account in the general ledger, and then prepare the ledger accounts of the three debtors in the trade receivables ledger. Now, if we look at the solution, firstly, our balance brought down. Now we know our trade receivables control account, it's an asset, and assets have debit balances, though. So therefore our balance brought down, because my opening balance is my balance brought down for the 1st of May, it's 1,350. Now we can just go back, and where our opening balances were given, our 450, our 680, and our 220 will give us our 1,350. So debtor A plus debtor B plus debtor C, that's how we get our 1,350. Then we have our sales and VAT output, which comes from our sales journal of 805 Rand. Now we said our trade receivables control account, it's only the total of our sales and that output. So to illustrate that to you, let's go to the sales journal. So here we have our trade receivables of 805, which is our sales of 100 plus our 105 Rand VAT output, because our debtors owe us this 805. So when they pay us, they must pay us the 805. But what we're going to record as sales will only be the 700 and then the VAT output of 105 Rand. And that 105, we then either going to pay to SARS because we owe it to SARS. It's not our money. Remember, we just receive it on the behalf of SARS. I mean, we're doing them an admin duty. We receive it on their behalf and it's not our money. This we need to pay over, except if we have that input which we can then deduct from this. But the VAT output is what we owe to SARS, and the VAT input is what we can recover from SARS or claim from SARS. So we have illustrated the 805. It's our sales of 700 plus then the 105 VAT output that gave us the 805. And remember, we said sales will increase because every time you sell on credit to the debtor, he's owing you more. So our debtors' balances must increase. And to increase an asset, we record it on the debit side because assets increase on the debit side. So our sales will be recorded on the debit side. Then we have our furniture and VAT output, which is also recorded here, which comes from our general journal, because those debtors also owe us that amount, but it's not recorded in our sales journal because it's not part of our normal trading items, our inventory that we sell. We don't buy and sell furniture. So when we go back to our general journal, we will note here the furniture, the VAT exclusive amount is 700 plus the 105 Rand of the VAT output, which gives us the 805 Rand. That's where our 805 Rand comes from. And again, it's a debtor that we sold on credit. So our asset will increase and our assets increase on the debit side. So that's why this transaction is on the debit side and not on the credit side, because our balance of our debtors must increase. And the only way you can increase your assets is by debiting your asset. Now, then on the credit side, we have our sales returns and VAT output, which comes from our sales returns journal. We said when the debtor returns merchandise to us, the balance of the debtor must decrease because the debtor owes us less. And to decrease the balance of a debtor, you must credit it. And therefore, if we look at our sales returns journal, we note that we have these transactions for debtor B and C. For the month, it was 60 Rand in the sales returns column, and the VAT output column, which we owe, well, which must be set off against the VAT output, is 9 Rand. And then the trade receivables, the VAT inclusive amount is 69 Rand. So that's where our 69 Rand comes from, the 60 plus the 9. So that gives us our 69 Rand here, and we're happy it's on the credit side, because to decrease the balance of a debtor, you must, or to decrease the balance of an asset, you must credit it. And therefore, our sales returns and VAT output entry that comes from the sales returns journal is 69 Rand on the credit side. Then our bank settlement, discount granted, and VAT input is 1,602. So this is coming from our cash receipts journal. Now, when we receive a payment from the debtors, or the payments, because this is the total of all the debtors paying us, that will also decrease their balance, or will decrease the asset, because they owe us then less. Any payment received will decrease the amount that they owe us. So therefore, the payments received from the debtors will also be recorded on the credit side of our trade receivables control account. And that is 1,602 Rand that comes from our cash receipts journal. So here we can see we received these amounts from our trade receivables. In our trade receivables, this is the full amount that the debtors owed us, less than the settlement discount granted and the VAT input. So the 89 plus the 13, if you deduct that from the 1,602, you get the 1,500. Because although the debtor owed us 1,602, they only physically paid us 1,500 because we gave them a discount of 89 plus then the VAT on that, which is 102 Rand. The 89 plus 13 give you 102. So if you subtract 102 from the 1,602, you get your 1,500 that you physically received. Now we must record the full amount, the 1,602, because that's what they owed us. Because otherwise, if we only subtract the 1,500, we're going to sit here still with a balance. But we've given them that discount. So they have actually settled their account. And to settle it, it must be the full amount that they owed us. Although we haven't received the full amount, the difference is the settlement discount granted. So here we record the full amount, the 1,602, which include, that's why we say it's the amount that we physically received, the 1,500, plus then the settlement discount granted of 89, plus then the VAT of 13 Rand. So it's the total. It's not just the bank of 1,500. It's the 1,500 plus then the 89, plus then the 13 Rand, which is 1,602 in total. That's what we must record here to get the full payment, or to get the full amount that they owed us out of our balance. Then again, we had the returns, which these debtor that we sold the furniture then returned. That came from our general journal. Here we said that debtor C then returned furniture, and that was the furniture for 220 plus the 33 Rand VAT. So the total was 253 Rand. So again, we must decrease our debtors in our trade, or the trade receivables control account must decrease. It's an asset, it decreases on the credit side. So we must decrease that balance with the VAT inclusive amount of 253 Rand. So that then gives us all the entries, our opening balance, our entries from the sales journal, our entry from the general journal. Then we had our sales returns entry. Then we have our cash receipts journal entry, and then our general journal entry where furniture was returned. So now we will have to go and add up the two sides. So we will add up the debit side. We get amount of 2,960. We're going to add up the credit side. We're going to see it's less than 2,960. So the biggest amount, or the column with the biggest amount, will be then used as the total. So we know our debit side gives us 2,960. So that will be our total. So we're going to use the total of 2,960 as our totals. So we must write it on the debit side. We must write it on the credit side. But then we know if we add up the credit side, we're not going to get 2,960 by adding up the 69, the 1602, and the 253. The difference is our balance carried down, and that is 1,036 Rand. So to get our total on the credit side to add up to 2,960, we must have a balance carried down of 1036. So 1,036 Rand will be our balance carried down. And remember, my balance carried down at the end of May will become my balance brought down on the beginning of June. So 1st of June, my balance brought down will be 1036. I think this 20.1 is not correct. That must still be 20.2. But June 1 balance brought down is 1036 Rand. So 1036 will be our balance brought down. Now, if we then check our list of opening balances, that was the 450, the 680, and the 220. That gave us the 1,350. We must now look at the individual ledgers for ledger account or individual accounts for the debtors in the trade receivables ledger. Now, we said debtor A had a balance brought down of 450. Like we said here, our balance was brought down for 450. Then we have to also then record each and every sales transaction for debtor A. And we said the sales will increase our data. So if we go to the sales journal, here we have our entry on the 2nd, and that was for 230 Rand for A, and that was the only transaction during May for debtor A. And remember, when we record, it's on the day of the sale that we need to record. So therefore, it's the 2nd, whereas in the control account, it was at the end of the month. So that's why our opening balance at the beginning of the month, our entries is at the end of the month because it's the totals. And the totals you can only get at the end of the month. May has 31 days, so therefore it's the 31st. Here also the 31st. But when we look at the individual accounts, then we must record it on the day that it physically appeared in the journals. So our opening balance on the 1st, then on the 2nd, we had sales and VAT of 250. Then if we look at, we will have a payment. We can just check just to make double sure. In the sales returns, there's no transaction for debtor A, so nothing coming from there. Then we have our cash receipts journal, where A paid us on the 15th. He paid us 600 Rand, but he owed us 680, and we gave him settlement discount of 70 plus then the VAT input, and that makes the 680 minus the 80 will give us the 600 Rand for A. So on the 15th, we have a transaction for debtor A. Therefore, on the 15th of May, we said bank settlement discount granted and VAT input is 680. And that's basically our balance plus what he bought is 680. So he basically settled his account, he or she. Then we have debtor B. Debtor B, we said, has an opening balance of 680 Rand. So for debtor B on the 1st of May, we say balance brought down because it's an asset. Asset have debit balances. Therefore, our balance brought down is on the debit side, 680 Rand. Then we're going to check if there are any sales in our sales journal for debtor B. So we go to our sales journal, we see yes, on the 2nd, we have a 460 Rand, because this is trade receivables. It tells me it must go to, it's a full amount of the VAT inclusive, the 400 plus the 60, the 460 the debtor owes us. So we will record the 460 Rand, and that's increasing my balance. So it must go to my debit side. So when we get to the entry, here it is on the 2nd, because it happened on the 2nd. It's sales and VAT, comes from my sales journal, the 460 Rand. Then we have, okay, we must go and check and see if there are any returns and any payments made by the debtor. So our returns will come from our sales returns journal. We see on the 8th, there is a return and it's 46 Rand. So the debtor returned some of the inventory merchandise that he purchased from us. He returned, or she returned, and that is 46 Rand. And that will decrease the balance. So therefore, that transaction will be on the credit side because my asset decrease on the credit side. So on May the 8th, my sales returns and that output is 46 Rand coming from my sales returns journal. Now let's check if there are any payments from the debtor. So when we go, we see, okay, my cash receipts where I received the payments of the debtor. Cash received, debtor B paid me 400 Rand. So there was no settlement discount because he probably just paid on time. So we know any payments will decrease the balance of the debtor. So that transaction must be on the credit side to decrease. So here, the 15th, my bank, I have 400 Rand. Now we must add up and see our debit side. We add up, we get 1,140 on the credit side. When we add up, we will see it's only 446. So we have a total of 1,140 on the debit side and a total of 446, because the 46 plus the 400 gives you 446. We know the 1,140 is bigger, so that will then be our total of the account. So we're going to total it here, 1,140. We know the credit side must also be the same total of 1,140. But we only have 446 on the credit side. So we must bring in our end of the month, 31st of May, a balance carried down of 694 Rand, because there is still an amount due to us. So we bring in the 694 Rand, balance carried down, and then June 1 balance brought down 694 Rand. So my carried down on the credit side will become my balance brought down on the debit side on the 1st of the month, June the 1st, 694 Rand. Okay. Then our debtor C. Debtor C had an opening balance of 220. It's an asset have debit balance. So on my debit side, 1st of May, balance brought down 220 Rand. Okay, now we must go and check, are there sales transactions? So we first go to my sales return. So this is what you do every time. You must do these transactions, postings to your trade debtors. You check the sales journal, you check the sales returns journal, you check the cash receipts journal, you check the general journal to see, are there any transactions relating to the debtor? Now here we have 115 Rand. It's the sales of 100 plus the VAT of 15. We know this will increase the debtor increase on the debit side. So there will be an entry on the debit side. So when we go to debtor C, we will note that there is our, on the 2nd, we have the sales and VAT output of 115 Rand. And then if you can remember, there was that furniture that we sold on credit. So here on the 15th, we sold on credit to C furniture for 805 Rand. That they also owe us, so that will also increase the account with 805. So debtor C will increase on the debit side with 805 on the 15th, 805, and it comes from the general journal. So this tells us sales journal was 115, the general journal, it's 805. Now we must go and check for any payments that will decrease our debtor. So in our cash receipts, we see then on the 15th as well, the debtor paid us 500 Rand, but he previously owed us 522, but then paid before his credit date. Before the 30 days, he paid us and then received his discount of 19, but which then must get that input of 3 Rand, which will make the 22 Rand. So 22 Rand, if you deduct that from the 522, he physically paid us the 500, but he owed us 522. So that we must bring in. It's decreasing his balance. He will decrease on the credit side because it's an asset decrease on the credit side. So we must bring in our bank settlement discount plus the VAT. So it's the bank amount, the settlement discount amount, and the VAT gives us the 522 Rand. Then, sorry about this, it's not on the correct lineage. The 522 relate to the amount that was received from the cash receipts journal, the payment, the 522, and then the furniture and VAT input is must relate to this general journal entry because they then returned some of the furniture that they all see, returned some of the furniture on the 18th, 253 Rand. So debtor C, that will decrease his amount that he owes us. That must go to the credit side. So furniture and VAT input from the general journal is 253 Rand. So again, then we know that we have recorded all the transactions for the month. So then we will have to go and add up the totals. Again, on the debit side, we have the 220, the 115, and the 805, which gives us 1,140 Rand. On the credit side, we have the 23 Rand, the 522, and 253, which is less than our 1,140 Rand. So again, my total of my debit side will become the total of my account. So on the debit side, we then total the 1,140. On the credit side, we must also total it at 1,140 Rand. And we know that the credit side is less. So to balance this, we need a balance carried down of 342 Rand to get to 1,140. Because if I take now the 23, the 522, the 253, plus the 342, I will get 1,140. So my balance carried down of 342 will then come down to 336. That's, yeah. Okay. There's, okay. But yeah, that we will, okay, that was according to the trade receivables. Okay. So we will look at the reason why there's a difference in that. But my balance would have been, my 342 would have been my balance brought down of 342. But according to this, it's now 336. So we will have to go and look and see what's the reason for this not showing 342. So when we then add up our balances, because remember I said in the beginning, our trade receivables ledger, the total of all the balances there must be equal to my trade receivables control account. Now, when we look at our trade receivables control account at the end, it is 1036. Okay, so my balance brought down at the end of May, the beginning of June, is 1036. So if I then add up my debtors balances as also at the end of May, that must equal then 1036. So we said A paid us, so A owe us nothing, B owe us 694, and C we have here as 336 or 342 according to our carry down. So yeah, I think this is just a mistake here, that 336 should just be 342 because my balance carry down should be my balance brought down, and that is 342. So if I take my 694 plus my 342, it gives me my 1036. So that shows to me that my balances as per my trade receivables ledger, because my debtor A owes us nothing anymore, debtor B owes us 694, and debtor C owes us 342 rand. And if you add that up, it gives you 1036 rand, which is equal to my trade receivables control account of 1036. So then I know everything is in place, because here I have only the totals, and when I only work with the totals, I get a balance of 1036, and then I must go and check my debtors accounts where I have the detail where every entry is recorded. And then when I checked my trade receivables ledger, I saw that A owes nothing, B owes 694, and C owes me 342. And if I then add that, I also get 1036 rand, and I know that my trade receivables control account is equal to the total of my debtors, the list of debtors. When I add them up, I also get 1036. So I'm happy that my trade receivables ledger is equal to the balance of my trade receivables account. And that brings us to the end of my presentation for today. Are there maybe any questions that anyone still wants to ask? Handa, can you maybe just check if there are any questions for me?
Thanks, Dion. We do have a question here. I was about to respond to it, but I think you can address it. They're asking what's the difference between balance brought down, BC and CD?
Okay. Balance carried down. Okay. BC and? Can you just repeat that, sorry, for me?
It's BD and
Yes.
CD.
Oh, BD and CD. Okay.
Yes.
Just to go back here, remember let's use one where we can see it clearly. Okay, B. When we look at when you balance at the end of the month, it's going to be carried down. The CD stands for carried down. The BD is brought down. So when you start something, when you start at the beginning of the month, you're bringing it down, because previously, if we look here on the 1st of June, I brought it down from this side. So here when I started, I brought it down. I brought it down from the at the beginning of the month, it's brought down. When I balance, I carry it down. So it's my balancing amount which I carry down. And then at the beginning of the next month, it's brought down. So from the end of the previous month, I brought it down to the beginning of the current month. So that's the only difference. And so my closing balance at the end of the month is going to be the carried down, and my opening balance at the beginning of the month will be my drawdown. So if you want to remember it like that, when you balance your account, it's going to be the amount that you use to balance your account at the end of the month. That will be your carried down amount to balance it. But after you've balanced it and you must open then the next month balance, that's going to be my balance brought down. So on the first day of the month, when I then open my account again, it's my balance brought down. So it's basically my opening balance. Here it was my closing balance. So my closing balance, when I balanced it, it's my carried down, and my opening balance, when I brought it down at the beginning of the next month, will be my brought down. So you can just remember by that, when you balance it at the end, it's carried down. And do you remember, if this was a creditor, our transactions would have been on the other side. So our balance brought down would have been here on the credit side, and then our balance carried down would have been on the debit side, and our balance brought down for the new month would have been on the credit side. So it doesn't say that, so don't be confused that when it's on the debit side it will be brought down and when on the credit side it's carried down. No, my balance that I use to balance my account will always be the carried down balance. So it can be on the credit side, it can be on the debit side, but it's the balance that I use to balance my account. So at the end of the month, my balance that I calculate will be the balance carried down, and then the balance that I start with for the new month will be my balance brought down. So my starting balance is balance brought down, my closing balance is carried down. I hope that explains it to you. Any other questions?
Yes, another one, Dion, I think you've already addressed it on your response, but just for the sake of other students, there is a question which asks what happens if the credits exceed the debit side? How do you record that balance?
Okay. In that case, your debtor is going to become then a creditor. Because remember, when but that's not going to be too many cases that you receive. But it can happen that a debtor might come and pay you more than what he actually owes you. So then you have to go and include that debtor now suddenly as a creditor, because you owe that debtor that amount, and you can't show a debtor with a credit balance in your debtors. You can't set it off against your debtors. You must classify it correctly. If you owe somebody money, he becomes a creditor of yours. So if you have then a debtor that either pays you, or because you've given him he returns stuff but then still paid for it, and suddenly he paid more than what he owed you, he will have a credit balance, but then he will be transferred basically from your trade receivables ledger. You will be transferred to your trade payables ledger. So he will become a creditor until he has a debit balance, then you will transfer him back. But you can't keep him with a credit balance in your trade receivables ledger. You can't have a debtor with a credit balance. Then that debtor with a credit balance becomes a creditor of yours, and you have to transfer that debtor to the or creditor, because he's not a debtor anymore because he has a credit balance. So he becomes a creditor, and therefore he must be in your trade payables ledger. Any other questions?
No, there are no further questions. Thanks, Dion.
Thank you. I think then if there's no other questions, then this will be the end of the presentation. Thank you for everybody. And remember, The link that we've provided you for this presentation, that's also the link that one can use when you want to review this video again. But I think also Mr. Mkadi will provide you with a link. But for the FAC 1501 students, the link that we've provided you for this specific presentation is also then the link that you can use if you want to review this video again. Thank you for your attendance, and enjoy the rest of your Saturday. And thank you for my colleagues for assisting.